Today, we're going to be talking about the redistribution of wealth and income. And we'll start by talking about why we would have an interest in redistributing wealth, different arguments for redistributing wealth. We'll then focus on a particular framework that's been very influential in economics, which is usually called the Merle's framework, which thinks about a trade-off between redistributing more money and discouraging people from working hard. And we'll try to quantify what are the relevant properties of the behavior of individuals, which will determine the optimal level of redistribution under that model, and look at some evidence about what those behaviors are actually like. And then in the last third of the class, we're going to talk about some alternative perspectives on income redistribution and try to discuss some of the limitations of the Merle's framework for thinking about optimal income taxation and other redistributive issues. So the main motivation for redistribution of wealth comes from the existence of large inequalities of income and well-being across individuals. And these inequalities have been in many countries actually growing. So the way that economists tend to break down inequality of wealth and well-being is into three categories. One focuses on the bottom end of the distribution of income and is called poverty. And this is typically measured by the fraction of individuals below some line, which is either determined globally by sort of an absolute level necessary for subsistence, which is usually $1 a day, or on a relative basis depending on the countries. So in the United States, the poverty line is $19,000 or so for a family of four, which is obviously much, much more than $1 a day because the US is a much better off country. And so there, things are measured more in terms of relative poverty than absolute subsistence. The interesting thing about poverty is that unlike other forms of inequality, it really has not been growing in recent years, especially not in developed countries like the United States, unlike the other forms of inequality we'll be talking about. So the second and probably most common form of inequality is sort of measures inequality over sort of the mid-range or the full range of incomes. So it doesn't focus on the bottom, it doesn't focus on the top, it focuses on sort of the mid-range or the full range of income distributions. And the most common one of these is the Gini coefficient, which measures how far from perfect equality the social distribution of income is. And this has grown somewhat over time, but not a lot. So what is the Gini coefficient? So if we graph on the horizontal axis the percentile that an individual is in the distribution of incomes in a society, and on the vertical axis, the percent of income held by people who are that well off or worse, then obviously if everyone had the same income, this would just be the 45-degree line. Because if you said the 50th percentile of people, 50% of people would have those people who's at the 50th percentile, people below that would hold 50% of social wealth. To the extent that there's inequality, this will be below the 45-degree line. The further it is below the 45-degree line, the more wealth is being held by the top, the less wealth is being held by people in the rest of the distribution, right? So this is called the Lorenz curve. And the further this is below the 45-degree line, the larger will be this area A that's between the line of equality and the Lorenz curve. And the smaller will be this area B that's between the Lorenz curve and the axes. And the Gini coefficient is the area between the Lorenz curve and the line of inequality divided by the total area. Okay. So the top part of the income distribution is usually measured by a third type of inequality. So poverty measures inequality at the bottom end of the distribution, Gini coefficient measures inequality in the middle range. Inequality at the top is measured by what's called top income shares, which is what part of the national income is taken by various definitions of the super rich. Now notice that by the nature of the Gini coefficient, this graph is not going to distinguish very much between those two things, right? If you think about changing income from being held by the top 10% to being held by the top 1%, that's not going to change too much because you're already in a small part of this, distribution. So Gini is mostly going to be determined by how much inequality there is over the broad range. Top income shares says how much is the wealth that's held by wealthy people concentrated in the absolute most wealthy people rather than just people who are relatively well off. And so that's usually measured by, say, what fraction of total income is held by the 10% or the top 1%. And this is the measure of inequality which has been growing most radically and rapidly in the United States and the United Kingdom in the recent years. So to get a sense for this trend, this is a graph created by Emmanuel Saez and Thomas Piketty of the share of national income in the United States held by various parts of the income distribution. So the black is the top 1%. The blue is the top 5 to 1%. So not the people who are in the 1%, but who are in the 5%. And the red is those held by the top 10 to 5%. So the interesting thing about this is if you look at the blue and the red ones, basically there's been a little bit of growing income from them since the 1950s and 60s, but it hasn't been growing all that rapidly, right? So they have held somewhere between 12 and 15% of national income for pretty much all of the 20th century through to 2010s. Pretty much the same is true for the top 10 to 5%. So they've held a little bit less, between 10 and 12% of income, but that's been almost totally steady over the course of the century. On the other hand, the fraction held by the wealthiest, those are people earning over $350,000 a year, who are in the top 1%, that was extremely high during the Roaring '20s. During the Great Depression, it plummeted. And after World War II, it continued to fall to a bottom that was reached in the late 60s, where that top 1% held only 9% of national income. Starting in the mid-70s, it skyrocketed, and then rose even more rapidly during the 80s, saw a brief setback during the 90s, and then took off again towards the late 90s and the 2000s, to the point where it reached almost 25% of national income. That is, that they earned more than twice as much as the top 10 to 5%, and about twice as much as the top 5 to 1%. So, to a large extent, the story of growing inequality in the United States has been a story of money going from wealthy people to extremely wealthy people, rather than going from the middle class to the wealthy, right? People who are earning, say, what a professor would typically earn, 10 to 1%, have really not seen large increases in the share of income that they're taking. What's happened is that money has really gone from the middle class, hardly impacting this group, and dramatically flowed to the super wealthy. Now, a very strong contrast to this is what happened in Europe. So if you look at France, Germany, the Netherlands, Switzerland, Japan, these are all countries that have pretty reliable income accounts. They too had very high income shares during the 20s. But again, during the Great Depression and after World War II, these fell dramatically. But rather than reversing in 1968 as they did in the United States, they continued to fall gradually to the point where this high 1% income group basically holds now the same fraction of national income in most of these countries, or less, than it did in the United States at the absolute bottom during the late 1960s. Now, across the world, inequality has been rising in terms of the Gini coefficient. And the fraction of people who are super rich has been following a very similar path to what it did in the United States, except that it didn't skyrocket quite as dramatically, because what happened in the United States has been offset by what was happening in these other developed countries. Okay. Now, in terms of poverty, the big story across the world has been East Asia. So the poverty rate in East Asia and the Pacific was almost cut in half between 1987 and 10 years later, 1998. And it's continued to dramatically fall since then. So now the percent poor on an absolute scale in East Asia is approximately, I think, 8 or 9%, whereas it was 26% in 1987, and in the early 80s, it was almost 40%. On the other hand, South Asia, which has also grown pretty well, has seen a much more gradual fall in poverty, and Sub-Saharan Africa, the poorest region of the world, has basically maintained the same level of poverty that it started with. Latin America, poverty has hardly been falling. It fell more since 1998. And it's actually been rising in Eastern Europe. But it started to come down a bit again after 1998. So poverty in the world overall fell by about 4 percentage points between 1987 and 1998. But if you exclude China from it, it hardly fell at all. So the overwhelming majority of the reduction in poverty in the world has occurred in China and other East Asian countries. Now, another interesting fact has to do with how much inequality is across countries and how much inequality is within countries. So a couple of other measures of inequality over the mid-range are the tail index, the mean log deviation, and the standard deviation of the logarithm. And you can compute those by basically pooling together all the people in the world. And if you look back at the early 19th century, the overwhelming majority of inequality was within countries. So countries were very, very unequal internally. There was, a landowning elite and a very poor rest of the society. Inequality between countries was very small. In fact, most of the countries of the world that represented most of the population had a pretty similar level of income. Fast forward to 1992, the situation is totally reversed. Inequality within countries has dramatically fallen by about a quarter, and inequality between countries has much more dramatically increased, 10 times what it was in 1820. So now we have a very different picture. If in the 1820s the primary problem of inequality was that there was an elite and less well-off people within any given country, the problem of inequality these days is overwhelmingly that some countries are much better off than other countries are. So if you think about the story of, the story that Karl Marx would tell, that, the workers of the world are all oppressed and should unite against the ruling classes, at the time he was writing, that was pretty much correct. Today, that couldn't be further from the situation in terms of inequality. Inequality is overwhelmingly across countries rather than within countries now. So in fact, if you eliminated all within-country inequality, you would only manage to eliminate about a third of the inequality that exists in the world. Whereas if you'd done that in 1820, you would have eliminated essentially all inequality that existed. Okay. So many libertarians and conservatives are skeptical of redistribution. So libertarians, sometimes the term is neoliberal. In Latin America, basically means the same thing. So I used to be very conservative and libertarian, in fact. And so I empathize with the arguments that these groups make against redistribution. And so I want to briefly try to go through them. So one standard argument is that, the most basic one is, the rich have earned their money. Who has the right to take it away from them, right? Now, a slightly more sophisticated version of this argument is that actually the rich people are better at doing things with their money. They're smarter, they know how to build things better, they know how to even create better charities, better businesses, and they'll do better things with those money. If you give it to people who are less well off, they're probably not as deserving, and they'll waste the money on not such useful consumption goods. Robert Nozick, who is a famous libertarian, argued that as long as the way that people got their money was fair, then them having that money is fair. That it's not about what's the end distribution of wealth we end up with, but whether the process of arriving at it was fair, and that's really the key. There's religious arguments for not redistributing. So there's a Protestant argument that wealthy people are chosen by God to receive that money, and that therefore man should not undo what God has wrought. Ayn Rand and other sort of radical libertarians argue that taxation and other forms of redistribution are fundamentally violent. They're forms of disguised violence, and therefore are illegitimate by their nature. Another argument put forward by fascists is that, or extreme nationalists, is that the process of redistribution and fighting over how goods are distributed leads to resentments within society, which destroy the solidarity of the nation against other nations. And that therefore, a country needs to not focus on redistribution within the country and instead focus on solidarity as a country potentially in opposition to other countries. A similar, less radical argument put forward by conservatives is sort of that every part of society has an appropriate role to play, and redistribution sort of takes people out of their appropriate social roles by trying to sort of mix up what they are doing within the society. So many of these arguments, especially if elaborated in a more systematic way, I think can be powerful arguments against redistribution, and I'm going to try to return to some of them later on. Not all of these arguments have been formalized at all, or certainly not completely formalized, and certainly very few of them have been carefully studied in a quantitative way. But what I'm going to try to do now is to provide something like a libertarian argument in favor of redistribution, which, at least when I first learned it, was very compelling to me as an argument for why income should be redistributed. And the idea behind it is very similar to a Christian saying from the theologian John Bradford, which was the epigraph for this lecture. He said, "There, but for the grace of God go I." So he was giving a sermon, and he saw being dragged along the street some person who was being taken to jail and who was very miserable. And he said, "There, into that man's shoes, but for the grace of God go I." So the Michael Lewis speech, which I assigned you guys to read, I don't know if anyone read that. It's very nice. It's his Princeton baccalaureate, tries to express a similar idea, that many of us have ended up in the positions we are in rather than in the positions that the poorest are in, mostly by luck, and that therefore we should think that we wouldn't want to take the chance of having ended up like those people are. And therefore we should have sympathy for them and seek to redistribute wealth towards them so that from sort of a ex ante perspective, we would be as well off as possible. So John Harsanyi originally, and later John Rawls, gave a similar argument to this. And Maria, did you read the Harsanyi article? Can you summarize the idea of the veil of ignorance argument? Do you know what the veil of ignorance argument is from Rawls? Yeah? Yeah? Yeah?
That is in that situation of how they define like the arrangements or the optimal arrangements of society.
Yeah. Yeah, that's right. So what they basically argued is that, look, we all seek to buy things like health insurance, insurance against fires, insurance against major risks of disasters that we face in our lives, right? And the basic idea behind that is money is worth more to us when we're poor than when we're rich, right? So we buy insurance against these bad outcomes. And so it seems reasonable to say that imagine there wasn't a market for car insurance or fire insurance. You might want the government to set one up, or if you couldn't get people to sign up for the contracts, you might just want to act as if they had signed those contracts, right? Because they would have bought them anyways. Almost everyone chooses to buy those. So presumably most people are better off having bought that insurance than not having bought that insurance, right? And presumably the biggest risks that you face in your life are about things that are even bigger than, medicine or whether your car crashes. It's, who you were brought up by, in what country you were born, how intelligent you were born, whether you were born handicapped or born brilliant, born beautiful or born ugly, right? And those are the biggest risks in life, and yet we don't have any insurance markets for those, right? Because before you're born, you can't really sign an insurance contract. So if you believe the logic that, if we didn't have insurance or medical or auto insurance, that the government should set up markets for those, or even act as if people had bought insurance on those and just make the right payments, then you probably should believe that the government should try to provide you some insurance against the biggest risks that you face in your life, which are who are your parents, where were you born, etc., right? And this is exactly, Harsanyi and Rawls argued, what redistributive spending does. It takes money from those who are well off, gives it to people who are less well off, in order to try to insure people against the risks, the most basic risks that they face in their life, right? So the idea is that you should imagine yourself being put in a position before you knew anything about who you were going to be in the world. And in that position, presumably, you would choose an arrangement of society that would maximize your expected utility behind that veil of ignorance. And Adam Smith gave a prescription somewhat similar to this. He said that a society's rules should be arranged as if they were being determined by someone who is impartial to what was going on in the society. An outside observer who had no stake in any particular person doing any better than any other particular person, and was just thinking about what would be the thing that would make, on average, people in that society best off. Okay. So this says that we should try to maximize people's average utility. And that principle is called utilitarianism and was defined by Jeremy Bentham as doing the greatest possible good for the greatest number of people. So as usual, we're going to write down people's utility as depending on their income and then on some other things that occur to them, right? These other things might include how much leisure they have, how good they feel about themselves and their identity, how enjoyable their work is, and so forth. And from the perspective of utilitarianism, we should put equal weights on you being any given person, and so we should try to maximize the sum or the integral over all people of the utility that they earn as a function of their income and the other value that they get from the other aspects of their lives. And we put equal weights on all people, capturing the idea that behind the veil of ignorance, you don't know who you're going to be. So from this perspective, inequality is really just another form of inefficiency, because it's distributing to people who don't have anything good to do with money, money that could be distributed to people who would have lots of good things to do with it, right? It's basically a failure to provide insurance, which is an inefficiency, a distortion coming from that insurance market not existing before you were born, right? Okay. So as we saw in the first class, one very natural way to represent the declining marginal utility of wealth is to assume that people have logarithmic utility. And that's what we'll do throughout the rest of the class today. So the utilitarian framework, I think, is a powerful structure for thinking about the redistribution of income. But it imposes a lot of strong assumptions. And I just want to highlight a few of those before we dive into it. So one thing that many philosophers dislike about utilitarianism is that it assumes that all the value that comes from a social arrangement has to do with the end consumption that people are able to enjoy, and not from the process by which that is arrived at. So for example, a utilitarian in principle should be okay with killing one person in order to save 100 people, right? And many philosophers are uncomfortable with that. We're going to ignore those types of concerns for the most part today. The second thing to note is that whatever conclusions we come to, the objectives of the utilitarian are fundamentally the same as the objectives of a Marxist, right? Marx said that we should distribute from each according to their abilities, to each according to their needs. And that's exactly the idea of utilitarianism, right? We want to take from people whatever will maximize the amount that we produce, and then distribute to people who need the most, whose marginal utility of wealth is highest. Now, of course, that's going to be constrained by the incentive effects of trying to do that redistribution. And that might be the right objection to Marx, that he doesn't think about the incentive effects. But I think other people have a view that there's something fundamentally unjust about the Marxist perspective. And if you believe that, then you really shouldn't find the utilitarian framework compelling, because the fundamental goals of the utilitarian framework are the same as the goals of Marx. A third question is, who is really behind the veil of ignorance, right? So are we thinking about all human beings? Are we thinking about just people within your country? Should we think about every one in South America, everyone who speaks your same language? Who is the set of people who you can say about, there but for the grace of God go I? I can imagine myself having been in that person's shoes. That's going to be a very important concern, and we're going to talk about that later in the class. A fourth assumption that's typically made is that everyone has the same utility for wealth, right? If people earn different wealths, that'll be because of bad luck or good luck or something like that. It won't be because some people value the things money can buy more than other people do. And that's another fundamental issue that we'll talk about later. And a fifth issue that I think is very important in the political sphere is the distinction between equality of opportunity and equality of outcomes. A lot of people will say, look, I believe in equality of opportunity. I think people should have the same access to success that anyone else has. But I don't think that that means that everyone should be equal in terms of what they get. Now that is a very complicated distinction to try to maintain, as we'll talk about later in the class. But for now, utilitarianism is just going to completely ignore that. There is no definition within a utilitarian framework of equality of opportunity. All there is equality of outcomes. Yeah, Oscar.
It's a little bit naive to think that everyone faces the same utility function. I mean, to assume that everyone has the same basis.
The reason why I'm pointing out to you all the assumptions that go into this framework is because I'm not sure that all their assumptions are all that plausible. But what I'm going to go through is the framework. And this is the framework on which I would say 98% of all work in economics on redistribution is based. Now, do I think that it's problematic in all sorts of ways? Absolutely. And I just want you to be primed to think how problematic it is before I describe it to you. And then I'll spend the last third of the lecture talking about all the ways in which it's problematic. So, okay. So, if what I've just said to you makes you uncomfortable with the notion of trying to improve equality quite as much as the utilitarians would, let me try to give you some other reasons why you might support redistribution of wealth. So one reason, which is the closest to the utilitarian framework, is what's called Rawls's maximum criterion. So this is a relatively modest objection, which still says we should think about things behind the veil of ignorance, but doesn't believe that we can think of expected utility. It doesn't think we can think, what's the probability of me being each person? Let me try to maximize that. Instead, it says, look, I have to just try to make the worst person in the world the best off possible. Because I can imagine myself being in their shoes. And I'm so risk averse that I'm not going to be willing to sacrifice even a small decrease in their well-being to make someone else much better off. I personally thought this is a silly way to look at the problem, but it is one that's been very influential. And it will be more egalitarian than the utilitarian framework will be. Another way of looking at these things, some people have said it's not just that we should try to equalize wealth across people because of declining marginal utility of wealth. Equality for its own sake is valuable. People deserve to have the same utility as much as possible. Now, of course, if that requires sacrificing an increase in everyone's utility, that's a problem. But to the extent possible, we should try to equalize utility across people. Again, that is going to be more extreme than Rawls's view, even more extreme than Rawls's view, and is going to be even more egalitarian, but is not fundamentally all that different from the utilitarian framework, because again, it's trying to sort of put people's utilities together. More different from that was a view that was summarized by Harberger in 1984, but has been repeated by many people. It's called the basic needs view. And the idea is that none of this has to do with insurance or with inefficiency of the wealthy not having anything to spend their money on. Instead, it's just about the fact that we don't like, as we walk around the city, seeing poor people, right? And so we should try to make poor people better off, not for their sake, but for our own sake, right? That's the idea. And that means that poverty, especially extreme poverty, exerts an externality, but it doesn't mean that you want to give money to the poor to do whatever they want with it. You give money to them only for the purposes of making them not so desperate looking to you. So that might lead you not to just give them money, but to give them things that will make them less of a dire situation, right? Now, Harberger's view gives a much better explanation in terms of people's moral views for what we saw about the dramatic increase of inequality across countries versus within countries. If people just care about not seeing so many poor people around them, that would lead them to redistribute within their own country, but not care very much about reducing inequality across the world. Right? Okay. So, what I've been describing so far are sort of various types of fundamental ethical reasons for wanting redistribution. But there's also some sort of instrumental and practical reasons for wanting redistribution. So one of the most commonly cited, but I don't think anyone in economics has ever written about this, is social stability. So a lot of people, including John Maynard Keynes, have argued that inequalities can create envy by the poor against the rich, and those can lead to various forms of social unrest. It can lead to crime, it can lead to riots, it can lead to revolutions sometimes, and therefore we should redistribute wealth not because we inherently value redistribution, but simply to maintain the stability of the social order. I've never seen anyone try to model this, even though it's a very influential view in the history of economic and social thought. Another view that many people express is that when we have a lot of people being poor, that's going to be inefficient and is in fact going to reduce economic growth. And the reason is that everyone sort of is born with an equal mind. And the most efficient thing is if everyone's able to make the same investments in improving that mind to make it as productive as possible. And in the absence of strong capital markets, as we talked about in lecture 2, it can be very hard to make loans to people if you're not sure they're going to be able to repay and so forth. Redistributing wealth allows the poor to develop their abilities and therefore increases growth by creating a more educated society. Another argument, which is very much associated with Daran Acemoglu and Jim Robinson, especially in their recent new book, is that concentrated wealth is inefficient because those who have a lot of wealth are going to have a hard time monitoring the use of all that wealth. They're going to have to, in order to manage it, to put it to productive use, have big firms that are run by other people. And those people have to employ people. The more concentrated the wealth, the further the wealth is going to be away from the person who owns it, right? And that's going to lead to inefficiencies because of all the principal agent problems that we talked about. Okay. Now, we'll talk later about the fact that most of these views sort of have a flip side to them, that almost all of these things that are used to argue for greater equality can also be used in many ways to argue for greater inequality, but I'm going to hold off on that till a little bit later. Okay. So designing a tax system involves a wide range of issues, right? One issue is, should you tax income? Should you tax people's consumption? Should you tax their savings? What mix of those things should you tax? How should you redistribute the money that's collected? Should you do it through direct income transfers? Should you do it through providing particular types of goods to people, etc.? Another issue is, what sort of deductions should you give for various things that people do? Should you give special or targeted deductions, or should you give uniform deductions? Should you have an inheritance tax when people leave money to their children? How many different tax brackets should you have, and at what rates? How should the administrative process of enforcement of taxes work? What should the government spend money on? There's issues about the structure of taxes for the very poor. Some people have advocated that actually taxes should be negative, marginal taxes should be negative for the very poor so as to get them into work. Now, all of these issues are very important, but I think the two most core issues in optimal taxation are, and the ones that have probably been the most prominent in the economics literature in recent years are, A, overall, how large should the burden of taxation be? How much should be redistributed sort of overall? Sort of what should the average tax rate on people be? And the second is, should taxes be progressive, with rates increasing as you get wealthier, or should they be flat? And these are the two issues that we're going to try to look at in a quantitative way during this class. Okay. So, we're now all utilitarians. We think that the poor have much better things to do with the money than the rich do. Why would we not make everyone's income equal? Why would we not redistribute to the point where everyone has the same income? Does anyone have an idea? Yeah, one.
Because nobody would like to work and get some more money because they have to pay more taxes to the government.
That's exactly right. So the more that you tax, the less that people work. So beyond some point, taxes are actually counterproductive. In particular, if you tax beyond some point, you're not even going to earn more revenue, right? Because you're going to reduce the amount that people work by so much that will actually reduce the amount of taxes you're collecting rather than raising it. And this is called the fundamental equity efficiency or insurance versus incentives trade-off. So the goal is going to be to maximize average utility, given that we can only use a simple set of instruments. In particular, we're going to have a linear tax, a tax that gets charged to everyone proportional to the income they earn, plus some surcharge that we're going to charge on people earning, say, over $1 million or over $300,000 or $400,000. Second, raising taxes will cause people to work less hard because they'll no longer have as much of an incentive. And third, all revenue that we raise is going to be given back to people as a lump sum. Now, in fact, a lot of revenue raised by the government is used to build public goods, which we'll talk about on Monday, but for today, we're just going to treat as if that money's given back as a lump sum. So to keep things simple, I'm going to ignore the income effects that that lump sum has. So one problem with giving people this lump sum is then they have more money regardless of what they do. That may be enough to satisfy them, and then therefore they don't want to work that much harder. Now, it turns out that if you actually look at the size of income effects that exist and so forth, very little of the analysis is affected by including that fact. Even though this is, unlike the other issues we've been talking about in the course, a case where changing the taxes really could radically change people's incomes, and therefore we might think there could be a significant income effect. But we're going to ignore that for now because it turns out that quantitatively it doesn't end up mattering that much. Okay, so the basic problem then is going to be that when we raise taxes, people are going to work less hard because of what's called labor supply elasticity. That when the marginal wages that they earn from working harder are smaller, people are not going to work as hard. And in particular, we'll quantify that by the percent fall in work when the wages that you earn fall by 1%. And we're going to assume, or just define, that people who are currently earning income I have an average elasticity of their income with respect to an increase in increase in wages of epsilon bar of I, right? So they might have different elasticities, but on average their elasticity is epsilon bar. And then we're going to begin by just thinking about the optimal linear tax. So if there's a linear tax, the after-tax wages that people are going to earn is going to be, or after-tax income people will earn, will be 1 minus the tax rate times their personal income, plus the tax rate times the average income of everyone else in society, right? Because they're giving a fraction t of their income to society and then getting that back as a lump sum that's the average of the income earned by everyone else. Okay. So after taxes, people's wages are their wage times 1 minus the tax rate, right? Because they only get to keep 1 minus the tax rate times their wage. So if the tax rate increases by 1 percentage point, Sebastian, how much is that going to cause people's income that they earn to fall? Well, we just defined this average elasticity to given income, right? That says by what percentage does people's income fall if their wages fall by 1%? So how can we use that to compute when the tax rate increases by 1 percentage point, how much does people's income fall by? You can do it on the board if you want. Miguel, did you bring some pens? Great, thanks. Maybe just throw it up to Roman or something, or if you can pass it.
This is after taxes, yeah?
Yeah?
So we have to see the relative of the wages of the taxes sides the post-tax. So it will be, and we saw that this is the elasticity of the income.
Yeah?
So this tells me how much it changed the incomes, and so it will be here that equations. Then I have here the elasticity, so it will be more. Yes.
So the first thing we need to compute, right, is by what percent do my wages fall when the tax increases by 1 percentage
Yeah.
point, right?
Yeah.
So to do that, you need to say, what's D, the after-tax wage, DT, divided by what the after-tax wage is, right? That's the percent by which it falls.
Okay, but I have to do like this, no? No.
Well, so you want to say what's D, the after-tax wage, so DW times 1
okay,
minus
yeah,
T,
right.
divided by the after-tax wage, which is W times 1 minus T, right?
So we
Okay.
cancel this, no?
Well, so then what's the derivative here?
Derivative here is, sorry, we have like, here is, so we derivative here,
Well, this is not part of the thing that you're taking the derivative of, right?
yeah, it was here, no?
No, well, you can put that in a minute, but first we just need to figure out how much the wage, by what percentage does the wage fall when the tax increases by 1 percentage point, right?
Yeah, by the equations that we have there, so we have to derive this, so it would be, I don't know.
Well, okay, we're taking the derivative of W times 1 minus T dt. What's the derivative, what's that equal to?
Okay. Minus W?
Minus W, yeah.
Yeah.
And then you have to divide it by W times 1 minus T, right?
1 minus T. So it would be,
So it's negative 1 over 1 minus T, right? So the percent by which your after-tax wages fall when the tax rate increases by 1 percentage point is negative 1 over 1 minus T. And then, how do we get how much that changes your income? You multiply that by the elasticity, right? So the percent by which your income changes when the tax rates change by 1 percentage point is the elasticity of your income with respect to wages divided by 1 minus T. Well done. Okay. So what that says to us is that if we increase the tax rate by 1 percentage point, the average income is going to decrease by what percent? Well, to do that, we have to say what's D, the average income, D taxes, divided by the average income, right? That's the percent by which the average income falls. And what that is the integral over all the income levels of the income that people are earning that level divided by the percentage by which their income falls, which is the average elasticity at that income level over 1 minus the tax rate, divided by the integral of the incomes. And so we can define that to be just this plain epsilon bar, which doesn't depend on this income, which is the income-weighted average elasticity. So we're going to weight across people by their income, and we're going to call that the income-weighted average elasticity of labor supply. Divided by 1 minus T is the percent by which total average income falls when the tax rate increases by 1 percentage point. Okay. So again, we're going to ignore the income effects of the lump sum transfer, and we're going to compute what total social welfare is as a function of the tax rate. So remember that social welfare, we're assuming people have logarithmic utility, is going to be the integral over all the income levels, the logarithm of the income times the income that people earn, which is 1 minus T times their individual income plus T times the average income, right? Now, remember that by the envelope theorem, we can treat each individual, because they've chosen their income so as to maximize their welfare along all other dimensions, right? They've chosen to earn this much income rather than engaging in leisure or other activities. We can treat their income as constant when we take the derivative with respect to taxes by the envelope theorem. So the derivative of this, right, is the average income times, how does that change? So how does the average income change? Well, on the one hand, when taxes go up, that's going to increase things by the average income, so we get this 1 here. On the other hand, the average income is going to fall by epsilon bar over 1 minus t, and we have to multiply that by t, right? That's the multiplication rule. So that gives us this term, and on the other hand, when we increase taxes, that reduces income by the level of income that people are earning, right? And then by the chain rule, we have to divide by 1 over 1 minus t times I plus t times I bar, right? So if we rearrange this, what do we get? Well, we have 1 minus t times the elasticity over 1 minus t times the average value of income times the average value of the welfare weight. What's the welfare weight? It's 1 over the post-tax income that that person has. We put more weight on people who are poorer, so this is going to be decreasing in people's income, right? Minus the expectation of the income divided by this, which that is the expectation of income times the welfare weight. So this is the derivative of social welfare with respect to taxes. Now, we can define sigma to be a normalized covariance between income and the welfare weight. So, normalized negative covariance between income and the welfare weight. Now, notice, income and the welfare weight are always going to covary negatively, right? Because the wealthier you are, the less we care about you, right? The poorer you are, the more we care about you. So this covariance will always be negative. So let's call the negative of this covariance, once we've divided by the average income and the average welfare weight, to be sigma. Now that's exactly equal to, remember that the covariance is the difference between the expectation of the product and the product of the expectations. So this is I bar times W bar minus IW bar divided by I bar times W bar, right? Okay. So if we just plug that in here and rearrange the terms, we get that the optimal tax rate is going to be sigma over epsilon bar plus sigma. So notice that, as I said before, sigma is always positive because wealthier people get lower weight. And the tax is increasing in sigma, right? As sigma goes up, that's going to lead to more taxation. On the other hand, it's declining in epsilon bar. Now, can anyone point out how that captures the equity versus efficiency trade-off? Yeah, go ahead, Roman. Yeah? Why does sigma capture the inequality?
Because it is the covariance between the income and the wealthy.
Yeah?
When the tax increases, the inequality decreases.
Yeah? But the key point, right, is that if everyone had the same welfare weight, there would be no covariance there, right? If everyone had the same income, there would be no covariance there. The covariance is coming from the fact that these things are spread out, right? It's sort of like the covariance between income and 1 over income, more or less, right? And so this is a measure of post-tax inequality. Okay. On the other hand, epsilon, as Roman pointed out, is the efficiency cost of taxation. The more people reduce their work when taxes increase, the more it's going to be inefficient to redistribute because it's actually counterproductive. So this provides a very simple formalization of the equity efficiency trade-off, and in effect, almost all of optimal income tax theory is really just some version of this equation right here. Now notice that imagine that inequality gets very large, except when we have very, very high tax rates. that's going to drive the tax rate towards 1. If inequality gets very, very large, very extreme, we're going to want to redistribute almost everything, even if there's a lot of response in terms of labor supply. On the other hand, as the elasticity gets large, or as the elasticity gets small, if there was no reduction in work when we taxed more, then we'd want to be, as I said, like Karl Marx. We just want to redistribute everything from the wealthy to the rest of the society. Okay. So the more inequality there is, and the less responsive people are in terms of how much they work to what the taxes are, the higher optimal taxes are. Okay. Now, this covers the way we want to tax most people in society over the main range. But a lot of people have argued that there should be extra marginal taxes on the very wealthy, right? And in particular, President Obama has recently, not so recently now, it's almost a year ago now, proposed a surcharge on the super rich. And I don't know if anyone read, but François Hollande, the president of France, is trying to introduce a 75% tax rate for people earning over $1 million a year, €1 million a year. So this seems like an important issue, and I want to now try analyzing how we should think about taxing the super rich. Now, one thing to notice about the super rich is that we really hardly care at all about the value that they place on the money they get. Why is that? So the social welfare weight that we put on someone who's earning over $1 million a year is about 1 over 1,000,000, which is about 1/20th of what an average person in the United States makes, over the welfare weight that you would put on an average person in the United States. So what that says is that we can basically forget about the welfare of the wealthy. We're really just viewing them as a source of revenue. We don't want to tax them too high, because that might reduce the total amount we get out of them. But we want to get everything out of them we can possibly get. We basically want to tax them at the point where we're maximizing the revenue extracted from them. Okay, so that is going to simplify the problem further. So imagine that we charge a tax rate T sub 10 to the 6th over people earning more than $1 million a year, right? Let's let I sub 10 to the 6th be the average income of those who earn over $1 million a year, right? Now, Oscar Serrano, what are the two effects that we're going to be trading off when we think about raising this tax on the super wealthy? Okay, does anyone else want to? Yeah? Yeah, exactly. So the first thing is that when we increase T 10 to the 6th, right, we're going to just mechanically get more revenue from the people who are earning more than that, right? In particular, for every percentage by which we raise it, we're going to get the average income of these people minus $1 million. We're not going to get taxes on less than $1 million, right? Because the people who are earning above that only pay taxes on the marginal amount that they get above that level, right? On the other hand, the income of those people is going to fall. It's going to fall at each income level by that income at that level divided by 1 minus T times the average elasticity of people at that level, right? And that's going to reduce the total taxes that we earn by the total tax on those people, T sub 10 to the 6th, divided by 1 minus the total tax on those people. Okay. So the total effect on revenue from increasing the tax on these people is going to be 1 minus, is going to be their income times 1 minus this, just like before, minus $1 million, because we don't earn any money on the people who are earning less than $1 million, right? So the optimal tax is going to equate this number on average to 0 for people who are earning over $1 million, right? So if we take averages, this becomes I bar 10 to the 6th times this expression, and the epsilon bar is now only taken among people who are earning more than $1 million, right? Because we don't care about the elasticity of people below that. So it's the income weighted average elasticity among people earning more than $1 million. Okay. So let's define alpha to be I bar sub 10 to the 6th divided by I bar sub 10 to the 6th minus 10 to the 6th. What's that? That's the average income of people earning above $1 million divided by the average amount that they earn that's more than $1 million. Okay. So then we can use the same logic as we did before to solve for the optimal tax rate. Oscar, do you want to try to solve for the optimal tax rate in terms of that quantity? Serrano, do you want to try? No? To solve for the optimal tax rate, just as we, for the very wealthy, just as we did before, using this definition here? Well, so this is set equal to 0, right? And you want to solve it for the optimal tax rate using this definition I gave here. You're not so excited about that. Let me just do it on the board, or maybe I have it on the slides. No, okay, I'll do it on the board. This is fine. This one's fine. So, we have I bar 10 to the 6th times 1 minus t sub 10 to the 6th epsilon bar sub 10 to the 6th over 1 minus t sub 10 to the 6th minus 10 to the 6th. Okay. So we want to set that equal to 0. So that is going to give us I bar 10 to the 6th minus 10 to the 6th is equal to I bar 10 to the 6th times t 10 to the 6th epsilon bar 10 to the 6th over 1 minus t 10 to the 6th. If we divide through by the average income, we get divided by I bar 10 to the 6th. That's what I'm going to call 1 over alpha, right? So this is 1 over alpha. And then we're going to get 1 over alpha times 1 minus t 10 to the 6th is equal to t 10 to the 6th times epsilon bar 10 to the 6th. And we move this to the other side, and we get 1 over alpha. Or why don't we just multiply both sides by alpha first, and then move this to the other side. So we're going to get 1 is equal to 1 plus alpha. We're going to get epsilon bar 10 to the 6th plus alpha times t 10 to the 6th is equal to 1. And so we get t 10 to the 6th is equal to 1 over epsilon bar 10 to the 6th plus alpha. I think that's right. How did I get rid of 1 over alpha? Oh, this was alpha times epsilon bar, and this is 1. So we can divide both top and bottom by alpha, and we can turn this into 1 over alpha. Okay. So, yeah? Because this was the derivative of total revenue that we earned from the wealthy with respect to the tax rate that we charged them. and we don't care about their welfare, so because they're so rich, we're just trying to get as much money as we can out of them, right? Okay, so what does this say? If 1 over alpha were a measure of inequality, this would be exactly the same as our previous equation, right? Turns out that 1 over alpha is a measure of inequality. In fact, it's one of the most classic measures of inequality. It's very related to the top income shares we were talking about. Why is that? Well, how did I define it? It was how much is the average wealth of people above $1 million divided by how much are they on average above that level, right? So that's sort of like a hazard rate, right? It's like how far are people on average above the current level of income that we're talking about at any given point, right? It's like how much inequality is there at the very top, right? Okay, so what this says is that, Pablo, can you interpret for us the conditions under which taxes should be higher on the margin on the wealthy rather than on most people in society by comparing this to our other equation?
So if 1 over alpha is higher than the other measurement of inequality,
Yep.
sigma,
Yep.
on the optimum place,
Yep.
then it will be efficient to tax more to the wealthy.
And what about the other factor, this epsilon?
If the epsilon is higher than the other,
Then it should be lower.
So it will,
Yeah, that's
so
right.
It depends on the relation.
Yeah, so the idea is basically that the more that inequality is higher at high incomes than it is over the main range of income, the more that we're going to want to have a progressive tax. And the more responsive are the wealthy than most people are to taxes, the less we're going to want to have a progressive tax. So you should immediately start thinking, well, we saw that Gini coefficient wasn't growing that much in the United States, but top income shares really were growing. That's immediately going to make you think we should be having an increasingly progressive tax in the United States, right? And the issue of whether the rich or most people respond more to taxation, we'll talk about in a moment. Okay. Okay. Let me see where we are. Maybe we'll take a 10-minute break. Well, let's wait a little bit longer. Okay. So let's try to get a sense for alpha and sigma in the real world. Now, one natural way to get a sense for sigma is to assume that the distribution of incomes over most of the range is log logistic. That's very close to being log normal. Log logistic you can do a little bit more analytical stuff with, and most studies have found that over the main range of incomes are basically log normal. So log logistic distribution has this form. Income is given by this. Alpha is not the same as the alpha up there. Sorry about that. And it turns out that one really nice thing about the log logistic distribution is you can calibrate its parameters directly from the Gini coefficient. So the Gini coefficient is equal to 1 over beta, where beta is this property of this distribution. Gini coefficient in the United States is about 0.45. So that's immediately telling you log logistic distribution is going to care about income, the spread of income over the main range and not among the super rich, right? So this is going to be the right thing to start thinking about, the tax rate we charge to most people, not the tax rate on the super rich. The mean of the distribution of income in the United States is about $46,000 per person, and that turns out to be this parameter under the log logistics distribution. So it gives you an alpha of about 32,000. So if you throw this into Mathematica, it will show you that the value of sigma, it looks like this as a function of taxes. So if taxes were 0, it would be around 0.5, and it declines in this sort of curvy way down to 0, right? And you can just compute that mechanically. So what do we then do? we want to solve this equation here, right? We know that sigma has the value that comes from that little graph that we made, right? And then we can plug in different values of the elasticity and graph the right-hand side of this equation against the tax rate, which is just the 45-degree line. And that will give us the optimal taxes. So we get these results. So if the elasticity of average labor supply elasticity is 0.1, we get the tax rates should be about a little bit under 70%, 65%. If elasticity is 0.3, they should be about 45%, or maybe a little bit higher. If it's 0.5, they should be about 39%. If it's 1, they should be about 25%. Right? Okay. And notice this should correspond to the total average marginal rate that people pay. Not just the rate they pay to the federal government, but to all levels of government. Added together. Now, calculating alpha is actually even easier, because the top part of the income distribution does not look like it's log normal. Once you get up above $200,000 or $300,000, remember that we said that top incomes, like among CEOs and so forth, look like a power law, a Pareto distribution. Now, the amazing thing is it turns out that that alpha measure that I was talking about is exactly the coefficient on the Pareto distribution. That's why I called it alpha, right? And we know that if alpha is small from the other class, that there's lots of inequality at the top. If alpha is larger, there's less inequality at the top. So alpha is a classic measure of the inequality at the top end of the income distribution. In the United States nowadays, it's about 1.5. Now, it used to be more like 3 or 4, but as we saw, income inequality at the top end of the distribution has been increasing dramatically. So we can just calculate that this is the Pareto coefficient by using the definition of the Pareto distribution we had before. We take the average value of income of people who are earning above $1 million, and under a Pareto distribution, the value of the distribution is given by this, and then we multiply it by income up top, and then not down below, because we're just here dividing by the total weight of people who are above 10 to the 6th, right? And we can crank through some not all that illuminating algebra by bringing out all the things that don't depend on income. Then we just have income to 2 different powers on the top and the bottom. And we integrate those because it's just a power law, which makes things very convenient. So we just add 1 to the thing and divide by whatever the coefficient was. Evaluate it at infinity, it's 0. So we just evaluate minus it at 10 to the 6th. That gives us 10 to the 6th, 10 to the negative 6 times alpha minus 1 on top times alpha on the bottom. That gives us that the average value of income of people who are earning above 10 to the 6th dollars is equal to 10 to the 6th times alpha over 1, alpha minus 1. So if we calculate 10 to the 6th income above 10 to the 6th on average, divided by that minus $1 million, you get alpha over alpha minus 1 over alpha minus 1 equals alpha, right? Okay. And alpha is approximately 1.5. So that tells us that with elasticities of about 0.1, 0.3, 0.5, and 1, we would get an optimal tax rate of 0.87, 0.69, 0.57, and 0.4. Notice that those are higher than the respective tax rates we got here. And so that says that because of the big increase of inequality at the top end of the US income spectrum, the optimal tax rates for any given elasticity are going to be higher on the super rich than they are on most of the population. And of course, the optimum is not just that people above $1 million pay a much higher tax rate, people below that pay the regular tax rate. You probably want to sort of have it gradually increase up. But that gives you kind of a basic sense for it, right? Okay. Now, what are the evidence that we have on elasticities? The elasticity of labor supply is probably the most widely studied parameter in all of economics. There's probably 1,000, 2,000, 3,000 papers written on this topic. Unfortunately, almost all of the evidence that we have are based on short-term changes. And these can be biased. So that is, we saw a change in the tax rate, and over the next couple of years, we saw what the effect that was on people's income. The problem with this is this can be biased upwards, because if the tax change only lasts for a few years, income may be an intertemporal substitute. I may be able to say to my boss, hey, look, don't pay me very much this year. Pay me once the tax rate is lower, right? And so there might not really be any change in the taxes. It might just be short-run substitution. On the other hand, it might be biased downwards because people might take a while to change their labor supply. So for example, an increased tax rate might not lead to people working less this year at the same job, but it might lead to them taking a less demanding job or not choosing a profession where they have to work really hard, right? Now, the evidence we have suggests that labor supply elasticity is extremely low among the rich, around 0.1, but that actually their taxable income elasticity, not how much they're changing, how much they're working, but the change in how much income can actually be taxed that they're earning is much larger, closer to 1. Now, Roman, why might that be the case?
Because the rich people can evade taxes more easily than the poor.
Yeah.
They can, for example, reduce their taxable income
Yeah.
by charity or something like that.
Yeah, so I think if you know rich people, you probably know two things about them. One is they're very ambitious, and they're going to be at the top of any social ladder you put them onto, and taxes are not going to keep them from doing that. So the chance that they're really going to reduce how much they work when taxes increase is not very plausible. But on the other hand, they're going to do everything they can possibly do to avoid paying taxes, right? And so that's basically what this represents. Now, I think a lot of people believe that most of this could be addressed by better enforcement, closing tax loopholes, or if tax loopholes are really valuable, well, then it's not so bad that people reduce their taxable income significantly because they're giving it to charity or to other valuable purposes, which we want to encourage them to do, right? Okay. So I think most microeconomists think the right number to put into this sort of a calculation is something like 0.3 or at the highest and probably closer to 0.1. On the other hand, the middle class is much more elastic, primarily because when taxes get higher, women drop out of the labor force very often. But on the other hand, they have less chances to avoid taxes. And therefore, their taxable income and labor elasticities are much closer to one another, probably closer to about 0.5. So that suggests that average income tax rates should be somewhere around 40%, and they should rise to something like 80% at the high range. So that's very progressive taxes and pretty high taxes in general. Much, much more redistributive than the current system of taxes we have in the United States. Now that could be because our current tax system is wrong or because the analysis that we've done is wrong. And we'll be talking about which one of those might be right for the rest of the lecture.